As you can see, this panel discussion is called CEOs in the Storm. I think for a trio of CEOs in the storm, this group looks pretty presentable. Just a little background on our panelists. Jenny Johnson runs a $1.5 trillion global asset manager. I'm sure many of you are very familiar with Franklin Templeton. Mark here runs a $46 billion firm specializing in emerging markets, and Mathieu runs a $56 billion alternative asset manager. So we have a tremendous range of investing expertise and asset diversity here on stage. I think that's a very good place from where to begin. My first question, panelists. We know America First has been destabilizing for the US economy. We know it's been destabilizing for the global economy as well. How? You've been hearing about this. I've been hearing about it. You've been talking about it. Uncertainty, a slowdown, and in some cases, a total halt in corporate investments, a loss of trust in the US as a reliable partner, as a reliable supplier, a breakdown of the rules-based order, stresses on global systems such as supply chains. As I say, we've been hearing about that. We've been talking about it here at the Qatar Economic Forum and, of course, over the course of the past 4 months. However, and this is a really big however, as of this morning, US stocks are within a few percentage points, like 3 percentage points, of a record high, and the MSCI World Index is within tens of basis points, less than a single percentage point of its all-time peak. So what I'd like to know from the three of you, starting with you, Jenny, is what exactly is the market pricing in?
Well, I mean, let's remember, we were just talking about at Davos, right? It was all U.S. exceptionalism, AI, technology advancement, you know, everything was positive. And then, of course, you had Liberation Day, which put the fear in so many people. But I think what people have realized is the Trump administration, and by the way, if you actually look at what he's been doing, he said he was going to do these things throughout the whole campaign, right? And so, you know, it's all about taxes, tariffs, deregulation, and, you know, government efficiency. So he's gone out and said, okay. And you have to remember, in the U.S., you have about 18 months to actually get anything done as a president, because chances are, and in particular, this midterm, chances are he's going to lose control of the House in this, and so he won't be able to pass legislation. So he's gone out and he said, okay, I'm going to, and immigration was the other, and he came right out. And on the tariffs, if you're going to get people to the table, and he, from what I understand, he genuinely believes, post-World War II, that the U.S. has been unfairly treated with respect to tariffs. And so he goes out and he says, okay, I've got to get people to the table, so you come out hard. You know, President Trump is a deal maker. We know that. And that, of course, scared the market because the numbers and the statements were, you know, obviously shocking. And then, you know, as it's played out a bit, and you hear now Secretary Bessent saying, hey, this is interactive, right? Tariffs go with the tax policy, and they go with deregulation. And so I think now that people have seen a couple of deals, frameworks done, you're seeing the tax legislation move forward, they're getting more comfortable with the story. And so you're getting back to, okay, this is a storm, but we'll get through the storm.
Mark, Mathieu, what do you think? You're active in public markets?
Yeah.
Do these prices make sense to you?
My view, but I guess I'm talking my own book, is it's incredibly expensive and doesn't price anywhere near the degree of uncertainty that it should.
Mathieu?
I think it's a very complacent market. You know, we cannot be that high on the public equity market, and I'm not a public equity person, but when the risk-free rate, or supposedly risk-free, is that high compared to where we were, you know, 2 years ago. So there's a disconnect. I think there is a lot of complacency. And I believe right now it's time to be very selective and prudent.
So, you were about to say something, Jenny?
I was going to say, complacency about what? Like, what are those risks that you think are?
I think there are, Jenny.
Sorry, Erik.
No, this is perfect.
You said to make it conversation.
The less folks you hear of me as the moderator, the better off things are.
Happy to, you know, in our view, is the fact that effectively the cost of doing business, defined as effectively what's the cost of liquidity, has jumped significantly, and I still believe that, you know, where we are today, and I don't want to just pick the 10 years as a reference, but in general, the cost of liquidity has increased, the quality, you know, the availability of credit is highly there's a huge dispersion because the credit markets are not open for everyone, and we know that you need access to everyone to make an economy functional. And I think that here, that's where the public market, being sometimes maybe restrictive because it does not capture a whole economy, or being somehow complacent.
And maybe on the ability of the Treasury to always reprice and issue in significant scale.
U.S. debt.
So I think maybe there's a bit of concern that everybody just assumes we can execute on all these savings via Doge, and we can put a tax bill through where we give tax breaks where we feel like, and it's all going to balance. The risk of execution around that while still funding what is a bigger and bigger deficit. I think maybe that's part of the complacency question, right?
And can I pick up on that too and just use it to challenge you a little bit, Jenny? I mean, what you were trying to do is explain, which is exactly what I asked you to do, why the market's where it is. But I want to know what you think. Do you have that much confidence? Do you feel that there's as much certainty as, again, an S&P 500 and an, Morgan Stanley World Index at those levels suggests?
So, look, I think the next 90 days are really important. I mean, look, first of all, earnings this quarter are going to be very interesting, right? Because this is where some of the tariffs have actually, impacted businesses. They've slowed down their spending. I just read something today that 97% of the folks that import are small businesses in the U.S. Now, it's 1/3 of the dollar amount, but so if we don't get some clarity around this and it really does start to impact, I think we can have a big problem. So I also, but you asked the question on how did we get back, right? And so I think that was a story of back. Going forward, we are in a really sensitive and important time, which I think we'll see kind of how it comes through. If businesses don't start spending again, it becomes a self-fulfilling prophecy, and that is a concern. And then, I mean, the U.S. debt is obviously a concern.
We'll come back to that, I promise. For a couple of weeks in the aftermath of Liberation Day, you heard a lot of people saying that a big sell-off in U.S. stocks had been overdue, and that the world was over-allocated to U.S. assets and equities in particular, and that it was time to rebalance and put money to work in European and Asian and emerging markets, public or private for that matter. Mark, I'll start with you here. How much of that is actually happening? What do the flows that you're seeing show?
Only a little at the moment.
Only a little?
Only a little.
So it's just talk.
It is, but there are two types of flows. Well, I guess everyone's a retail investor in the end, but there's retail and institutional. And the institutional flows just take longer. So if and obviously Mathieu will have a view on this, but if I look at our European and Asian investors, they've already been saying since about 22, when they started seeing the Americans go exit stage left, they've already been saying, how much marginal dollar do we want? How many more marginal dollars do we want? So they're already beginning to look at other things to do. American capital, we're not seeing much of that yet. A little bit in retail and in emerging market equities, a little bit of that's picking up. I think that's a little bit to do with people thinking, oh, hang on, there's this AI thing and it's all terribly fantastic. But America doesn't have a monopoly on that. And there's somewhere that is actually quite cheap that we maybe should start looking at, which is China, that is already clearly trying to develop places there and has put some effort into that and has already started to threaten some of the existing players in that space. So it's just beginning. Sorry, carry on.
Over the past 5 years, every dollar invested in the world, 80 cents were going to the US, across the board, public, private, equities, private, fixed income. And so obviously, back to basics, prices were going up because you had this marginal dollar coming in, rightly so. And we saw that, when the market started to freak out a bit, the public market was the first one to react, and partly, the very large cap, presumably the most liquid. And I agree with Mark, we have not yet seen on the private side, because it takes some time, right? I mean, you saw the announcement of some large asset owners that they wanted to sell off the private equity, for example. It takes some time. So the intention, it's not about leaving the US. I think it's about after such flows, you end up with an allocation that is disproportionate towards the contribution of the real economy to the world, GDP or whatever measure you want to take. So I think that's what we're seeing, and marginally, be emerging market, Asia, Southeast Asia, you saw Japan also, yesterday, and Europe, we will see some increase,
I mean,
Jenny, you have a huge, sorry, Mark, go ahead.
The US has 26 trillion of net liabilities. 10 years ago, that was 7. 26, so the 19 trillion has moved in terms of net liabilities in the last 10 years. That is a big amount of money that's come over from somewhere.
Jenny, I was about to say that you have many institutional clients and a vast pool of retail investors. What are those flows telling you?
Well, so a lot of people say, well, did people head to Europe? The European index was the best performing in the first quarter. When we were at Davos, people would talk about, they'd go around the world and they actually would just not mention Europe. I mean, that was like kind of the view, and it's the best performing index. But let's remember, there were things like Germany doing a stimulus program. There were, a lot of reactions that happened to sort of the U.S. position that actually made it appealing to switch investments versus saying, I'm losing faith in the U.S. That's number one. True. Second of all, the reality is we are still living in a time of amazing technological innovation. And with respect to AI, like we're barely have begun to see. The productivity gains that you've seen in the U.S. are from technologies that came, with the digital assets and, 20 years ago. That innovation has so far been led by the U.S. And so, I actually prefer, I think it's better for the world to have, more success kind of globally. But you got to ask yourself, like, why isn't there a bunch of unicorn companies in Europe? What is it structured? It's not like there's not great, entrepreneurs with great ideas. Why is it that they're so focused on the
Shall
US?
we ask the European?
Yeah, I mean, the short answer to that is, you're probably talking about these giga caps, who have attracted so much capital to fund effectively, this innovation. I was focusing more maybe on the lower part of the economy, the mid-cap, those people.
I was being mostly facetious.
Okay.
No, what I do want to know, though, is you're right, Jenny, that Europe has not created the same number and the same size of technology giants, certainly, that the U.S. has. But important things are happening in Europe, aren't they? Right? Europe is starting to shift away from decades of dependency on the U.S. consumer, and it's being forced out of the U.S. security blanket, and it's moving toward a position of greater economic and especially defense self-reliance. I say it's an important shift. How important a shift do you think it is, and how are you telling your clients to think about this?
Well, it's actually critical, it's a survival, if I may say, need, and it's almost a reindustrialization of certain markets. Yeah. And here again, I mean, you need to fund that. You're not funding that with some passive public investments. I mean, you need the real money getting into this part of the economy, and defense is an obvious one. It's 3% of GDP. We're going to be increasing that. We're talking multi-billions. That cannot only be funded by public money, because there is no public money anymore. It's called debt, right? So someone has to come, to match that, and that's a great opportunity for private market investors, and that's a global, global statement. And in Europe specifically, I mean, we see the plan that the Germans, have been putting forward. Obviously, in France, under the leadership of President Macron, the many initiatives there, and there is some asks. Actually, I even had that from a US LP, a couple of months ago. It's an inbound call. We want to be more exposed to European defense growth because valuation starts from a totally different level, so you can get the uplift.
Yeah, I mean, I think the interesting thing is that people believe the US always gets it right in terms of entrepreneurial and animal spirits. And there is a slight tendency to think Europe never does. The structural inefficiencies make it very difficult to do. So I think Europe has, yes, we can all do the trade to buy the currency and think, there's going to be lots of growth with $1 trillion from Germany and 800 billion from the EU. But I think people will probably want to see it proven in Europe, and it may struggle a little bit in terms of seeing it proven for a while, whereas the US has had the benefit of doing it so many times that people feel very comfortable capital gets applied better there. It has its barriers, it's lots of things, but there's a lot of structural reform, there's a mentality, there's horrendous labor markets in Europe to deal with. So I think it's going to be very interesting seeing that hopefully swing into a bit more balance, because Mathieu's right. Europe has got to reindustrialize, basically. It's got to go back to what it used to do very well. And that means infrastructure, energy, smaller companies, larger companies, and of course defense. But it's not just defense. It's about the infrastructure to be able to do the defense.
And if I were to say the one worry I have on the, as I said, it's amazing the U.S. has led so much on innovation, is hubris. Because I talk to some folks and they'll say, look, China's just copied us. That's all the U.S. Well, China's leading in a lot, like robotics are pretty impressive. You look at the EV batteries. I mean, there's a lot going on in China, and I think for the U.S. you have to pay attention and acknowledge.
It's hard though.
Possibly even military. I mean, this little skirmish India-Pakistan, how good was that jet? So there's even that's hypersonic. So we've all got to keep going to stay ahead. And you're right, hubris is a risk for all of us, not just for the U.S.
Yeah. What I was about to say is that, again, of course, you're right that there's extraordinary stuff going on in China. It's hard to invest in.
Absolutely.
So Mathieu makes the point that there are some easy or somewhat obvious America First trades to look at, like European defense. What are some of the other, maybe not so obvious America First trades to explore? And when I say trades, I don't mean something that you're going to buy today and sell 10 seconds from now. I mean something that an investment, something that, particularly in your case, you're not looking for short-term investors.
I'm happy to start here because there is too much debt in the system, public, private, and that we're coming out of a decade of very cheap, if not free money. There's been even more of those products, put into the system. Right now, the best and single most exciting investment opportunity is to do secondaries, private credit. So you actually buy out of some investors some matured vintages into some direct lending, corporate debt. I mean, you saw, Erik, we're now at 6 to 7% trailing default rate in mid-market corporates. And by the way, this is before tariff. We're talking, Q1. And to Jenny's point, when Q2 comes out. And so now you can be a price setter and no longer be a price taker. And I think this is the position you want to be in, in this market.
Mark?
Yeah, I agree. Generally, illiquidity is your friend when you have cash. So I think anything where people get a bit sweaty, spreads move out, is always a nice place to go. And in some ways, there's always distress situations from time to time. We haven't had a big structural distress trade for a long time because the flood of liquidity has really been keeping things up. So I do think if we get, not even recession, much slower growth, we may see that distress ripple around the world and provide quite a lot of opportunities. Is there a lot now? Bits and pieces. The other thing that interests me is in what I do is the larger economies that need really long-dated assets as they try and build their capital markets and build their own pension systems, where you can fund things in local currencies, you can build things where you're not totally dependent, there's not a big FX risk involved. So long-dated assets in the infrastructure space.
Which markets in particular?
The bigger ones, the Indias, the Brazils, the Mexicos, the Indonesias, here. If you combine the GCC, very, very interesting place to invest in my view. And has some capital that can come alongside you, which is also attractive.
If I could just pick up on liquidity, because you saw what happened 3 weeks ago, a month ago, how quickly the liquidity can disappear. On the treasury market,
exactly.
On the bond market, on the loan market. Remember that we had a month ago the highest, the record in terms of number of days without an issuance of a leveraged loan. That was, even higher than during COVID, when the world came to an end. Here, the world was not coming to an end.
And
there was just discussion.
And the 10-year was backing up
Exactly. So this whole liquidity and the outflows on high yield were all-time high. So the liquidity can disappear very quickly, and that goes back to the complacency, Jenny, where we should be careful that that can disappear very quickly.
It's a very convenient segue to what I promised the audience I would return to, which is U.S. debt. Last week, I think, as everyone here knows, Moody's became the last credit rating service to strip the United States of its AAA rating. It's a bit of an annoying question to ask, I'll admit, but I do want to know how each of you responds to it. Do you still think of treasuries as a risk-free asset?
Want me to start?
Sure.
One word answer.
I mean,
why doesn't Jenny start?
no, I mean, yes. Yeah, I mean, look, I don't think if you hold treasuries today that the U.S. is going to default, right? The problem is when you're looking at it, people, it's still the most liquid. Where else are you going to put your money, right? I mean, what other currency are you, where are you going to put it? And so, yeah, I think it becomes the benchmark still for risk-free.
Mark, your one-word answer
or remains the benchmark.
I agree with everything you've said, but I would say no. I never thought it was a risk-free asset. One of the easiest things to do when you get too indebted is try and inflate it away. And then you can start to take some pain, not just in credit, but in currency. And the currency cost, if you're not a US investor, can start to get painful.
The highest debt to GDP since World War II, I mean, we know what the deficit is. It's not about the default, it's about the fair pricing of the underlying risk. And unfortunately, that drives the repricing or the pricing of all other risky asset class. So as it moved, and it moved significantly, I'm still not comfortable with the pricing of certain risky assets as a consequence of the level of these so perceived risk-free assets.
So then what is risk-free? What becomes the risk-free benchmark?
I don't think there is any risk-free asset in the financial markets.
So there's nothing. So it's as good as you're going to get.
It's as good as you're going to get.
And that's a fair point.
Yeah.
And remember, even when you had cash at the bank in 2008...
If you get inflation, then it's...
But it's as good as you're going to get because
the banks went bust.
What's that?
Even when you had cash at the bank in 2008, some banks who were AA rated on the Friday did not open on the Monday.
Yep.
Yeah.
So here's perhaps a more useful follow-up question to that. A friend of mine who runs a multi-billion-dollar hedge fund drew what I thought was a great analogy the other day. He said if you treated sovereign credits like wine and conducted a blind tasting on fundamentals only, right? Names hidden, you can't see the labels, don't know who the vintner is.
The U.S. would be an emerging market?
The U.S. would rank at least 2 notches lower, he said, than the equivalent of AA+, as in AA-, like France or Slovenia. And there's obviously some truth to that. What really matters isn't whether the U.S. is or isn't considered a risk-free asset. The question that really matters is how much longer can this persist? How long until America faces a reckoning in the bond market?
Who are we asking?
All of you.
I can kick off if you like.
Yes, please.
I think it has one fantastic tyrannical thing, which is a massive liquid market. And in the end, it can probably last as long as liquidity is where it needs to be everywhere in the curve. And the thing that gets people most concerned, which is why recently was quite interesting, was that curve breaking down and there being real liquidity problems. Because the US has always basically said, we will issue and let the curve reprice. And when they start not necessarily doing that, or they start holding back issuance because they're worried about pricing, then it begins to start as a bit of a reckoning. But I agree completely with Jenny. It's a huge liquid market, and it's something, well, it does, I think the fear of that is driving people to make some very interesting investment decisions about things that you have to ask, what is their fundamental worth? Can I eat a piece of crypto? Can I...
I was waiting for when you're going to get to Bitcoin.
Yeah.
I mean,
sorry.
No, it's supply demand. It's like, fine wine. Fine wine, they sold Bordeaux in primeur, okay? So over the past 5 years, you would buy the top Bordeaux for 600, 700 euro a bottle, in primeur. The primeur came out last week. They're offered at 300 euro a bottle. It's called supply demand.
Jenny, last word to you.
Look, it's not a problem until it's a problem. And oftentimes when, a crash happens or a market correction happens, it's something, I was reminding somebody recently that, in 1987, it was the trade deficit. Like, that was the trigger. Nobody had been really talking about the trade deficit, and suddenly. And so the problem is we are in a business of confidence.
Yeah.
And nobody really can figure out, what triggers suddenly a loss of confidence. And the benefit the U.S. has, which is allow it to continue to spending the way it's spending, is that there just hasn't been alternatives.